Hello and welcome to Core Finance. I'm Matt Brown. I'm joined by Chris Justham, who is a relationship manager, I should say, at 7IM. Chris, thank you for joining us today.
Good to see you, Matt.
Equity markets grinding higher. Is this a case of complacency potentially in the market? Is it passive funds? Is it a case of actually markets are efficient and performing as they should be? Not stellar, huge bull runs, but just grinding higher and doing maybe what equity markets should actually be doing.
I think the fact that everything seems synchronised at the moment, you've got this synchronised global expansion across the majority of sectors, across different asset classes, it's led people to feel like they're in this kind of benign environment where volatility has been suppressed for many, many years now with quantitative easing. But where is the volatility at the moment? I mean, when we even looked at the numbers the other day, there have only been 8 drawdowns of 1%. Sorry, 8 days of absolute moves of more than 1% throughout the whole year. And to give some context to that, the last time that happened was the 1960s. And that's the S&P 500 specifically I'm talking about here. So we are in an environment now that any fund manager that is looking after a book has not been in before. So we are entering into new territory and people are having to work out what it is they're going to do, because the correlation, if you like, that's happened between fixed income and equities, where everything seems to be slowly rising. Yields are obviously at the floor where fixed income is concerned. You can't jump out of equities if you think that they're looking a little bit hot and just go into fixed income and developed market and think, I'll sit this out for a while, because that's not going to fly anymore, because central banks are looking at tightening. So they're going to be looking across the board pretty much, whether it's the Bank of Japan, whether it's the ECB, so we've got Mario Draghi coming out to talk tomorrow, whether we're looking at the Fed in the US or in the UK, the trajectory is going to be upwards. And if you're going to be in developed market bonds, you're going to be hurt as the yields start to tick up and then the capital prices fall. So you're having to look elsewhere and work a lot harder, really, in order to make sure that you're not getting complacent, because it's very easy to do so, I think, given, as you said, that things seem to be going indiscriminately upwards, albeit grinding, using the word you mentioned.
And it feels like, certainly for a lot of fund managers, it's running to stand still. It's not... The search for yield is becoming harder and harder and harder, and therefore equities seem the place to be. But I mean, also in the equity space, we have seen companies. There's been a few profit warnings, certainly in the FTSE companies, and it feels the market is punishing companies that aren't performing. And that, to me, it's a good sign. It means that the market is healthy and efficient. As a fund manager and relationship manager yourself, what are you doing now for clients? I mean, there could come a point where we do see a drawdown and a sell-off. How are you positioning yourself ahead of that?
It's a great question. So we're having to forego some of the upside that may continue to happen. So if there continues to be the synchronised growth that I mentioned, and GDP continues to tick along globally, Europe continues to recover. In the US, they're able to deliver these tax reforms. I mean, even Mnuchin's mentioned the other day that if they can't deliver from a tax reform perspective, he expects there to be a correction, because that's what's propelled those equity prices higher. Arbe's, secured, if you like, his future for a good few years again. So all of those things combined, and a lot of these political risks now in the background, would indicate, on the face of it, that things seem to be okay. The difficulty is, from our perspective, that if we continue to chase these returns up higher and higher, particularly when there's such narrow market leadership in the US, I'm speaking about specifically here, in Asia as well, where you've had some of the tech firms do really well, all it takes is a cyber attack. Or for Apple, as a prime example, the other day, their share price slipped slightly because the iPhone 8 sales disappointed. So people are now waiting and saying, well, hopefully that'll just be because people are waiting for the iPhone X. If the iPhone X also fails to deliver, would Apple and Alphabet, which relies 60 to 70% of their revenues on that one product, what's to say that it wouldn't unwind? And if they then unwinded, then the other tech stocks around them in the sector could arguably unwind as well. And then all of a sudden you've got a bit of a sell-off. And if it has been such narrow market leadership that has pushed forward those indices so high, there's nothing to say that therefore that wouldn't obviously work on the downside for investors. So from our point of view, we've taken some risk off the table where equities are concerned. So we're underweight now the US, we are underweight Asia Pacific, we've taken some risk off there. Remain neutral on Japan. But Europe is the only area really that we're overweight in comparison to, if you like, our neutral perspective of the world. We think that the FTSE 100, some of the valuations there are pretty high, but more importantly, as we think that there's a greater case, arguably, for a softer Brexit now, that pound, the weakening of the pound that propelled forward the FTSE 100, and the fact that 80% of the revenues from a lot of these companies come from abroad, therefore their profit and loss accounts look really healthy as a result. The accountants are patting themselves on the back. If there is a softer Brexit and there's a case of pound strength, again, that could impact the FTSE 100 companies. So Europe, which has been, if you like, a couple of years behind the rest of the world where their recovery is concerned, is one of the only places we like where equities are concerned, because, again, all it takes is a certain sector, commodities, to unwind slightly. As I mentioned, weather, for example, another one that always tends to impact the US in the first quarter of the year, and everyone's surprised, even the fact that it happens every year. That then could knock people's confidence, and if there's a knock in confidence, that's when you tend to see sell-offs. So we're holding higher cash, we're still holding gold, we've got more alternatives, we're having to work a lot harder, look into other areas that may be market neutral, some of these absolute return strategies, albeit with good liquidity, that maybe we wouldn't have looked at before because we would have just nipped into bonds. So it's a difficult environment.
I mean, understood as well, and with coming into the, well, we are in the final quarter, and it feels potentially as if you're a bit ahead of the curve, because it feels that at the end of the year, a lot of fund managers will be doing that exact trade. So it's great that you're doing it now in October, because there may be, not necessarily a run to the door, everyone clears off the dance floor in one fell swoop, but it does feel over the coming months that a lot of people will say, look, we need to lock in profits for 2017. The performance has been strong, but a profit's only as good as when you actually take it and crystallise it. So at 7IM, it does feel that you're probably ahead of the curve.
Yeah, the difficulty is when you look at relative performance and you compare yourself, for example, to a sector or whatever benchmark you pick, if you are going to go risk off before the rest of the herd, you are going to lag if, as we said, the equities continue to go forward, regardless of whatever risks on the horizon, and people continue to buy into the story of, we're all okay, it's fine. Let's ignore all of those risks that even 2 years ago, 2015, were enough to send everyone to the door. You have to suffer over the short term from a relative performance point of view, but we're willing to do that because ultimately, if you're looking after people's money, it's a privilege, and you can't take bets or just run with the herd, because that is absolutely the wrong thing to do. You shouldn't be following the masses. You should be putting your decisions and your judgments based on what it is you see out there. And for us, we're happy, if you like, to forego some of that in order to protect from the downside, because we see that as a potential real risk.
Understood. Well, on that note, Chris, thank you very much for joining us today.
Thanks, Matt.